Hey everybody, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. And sometimes we pontificate about once a year on the coming market crash.
That's right. We did the show last year. I don't know if we're going to go with the same title. We've not decided that yet, but that's what the working title is. Market Crash 2026, parentheses, ominous music.
No, we're going with we're absolutely
the same? Okay.
Yes.
Cool.
Well, no, it's because it's 2026 and not 2025, because that's what we did last year.
Yeah.
So, yeah.
But
it's interesting. Jason Hall. He's Jeff Santoro. They call him the voice of the people because I'm a good investor. And, well, hi, Jeff.
Hey, buddy.
How are you?
I'm great.
We're going to get into the details of why we want to do this podcast, but let's do the housekeeping first.
Yeah. Try to remember to do the housekeeping up front here. Encourage people to give us 5-star ratings and reviews on the podcast apps. That helps people find the show. And just real quick, if you want more of us, because who wouldn't, we got a YouTube channel. We have a Patreon that you can sign up for free to get information. And if you want to pay $5 a month to get reduced ad episodes and access to our Discord for conversations with us and with other paying members. And also once a month, we do a rough cut exclusive to the paying members of the Patreon. So if you want, those are always a lot of fun.
Jeff uses grown-up words on those.
Every once in a while.
Yeah.
But as always, all the stuff we're doing, besides what you're listening to right now, is in the show notes, links to everything. So we encourage you to flip through there and subscribe to things and sign up for things and support us. We appreciate it.
We're doing a sale on our Savvy Trader right now. I'll talk more about that later, but I just wanted to mention it now for people that are thought about doing the premium Savvy. We'll give you more details a little bit later in the show. All right, Jeff. As I've just pseudo-pitched joining a service to help you find stocks, here we are again. The market's at all-time highs. There's a lot of reasons to be maybe uncertain in the near term around what the market's going to do. We're going to talk about some of those things. But here's what I want to start with, because we do our Reckless Prediction show close to the end of the year every year. And we did the market crash episode last November. We've done similar kind of themed shows before about volatility to the downside and all of those things. And there's what we say and there's how we feel, and there's what we do. So I really want to make sure in this episode, we talk a lot about, having a good framework and thinking about reaching into your toolbox and using the right tools for the short term and the long term. But as a starting point, how did we do when we didn't really predict a market crash, but we certainly were talking about feeling market crash vibes last fall?
Well, that's what's so interesting about this. And we sat down to plan the show for this week and had the idea to do this. Like, let's do another market crash episode, because this is something we've talked about offline and in other venues a lot over the past bunch of months. I mean, I've been saying it out loud to my computer screen since April, that it's just a matter of time. It's just a matter of time. And here we are many months later, and it hasn't happened yet. But when we went back and looked, it was just funny timing that it happened to be almost a year ago. It was, like we said, it was in November of 2024 that we did this episode about Market Crash 2025. And I went back and looked at the planner, and some of the topics were similar to now, right? Especially the vibes in the market feeling frothy, the run up that it had had. But the main drivers, I think, that made us feel where we might get a crash a year ago are slightly different than now. And I'm going to get to how we've done since then. But the other thing I want to just really drive home is imagine if you or I or someone listening had decided a year ago when we did that episode to go to cash or stop investing. Because here's what happened. So right after we recorded that, over the next 5 months, the market was actually down. If you look 5 months ahead from that episode, it was down. But since that point, the S&P 500 is up 12% and the NASDAQ's up 17%. So that's basically a 14 to 20% annualized clip since then. So I don't think we said anything about not investing in that episode. In fact, I probably would bet we'd said the exact opposite. But this is my whole point and why I think this is interesting, because like I said, I've been saying since April, it's only a matter of time. We're going to get a downturn, but I keep buying stocks. I've really not changed my process at all. And we'll talk about that as we go through the episode. And it just goes to show you that trying to time the market and make a drastic decision about doing something differently can really come back to haunt you, because I would have lost out on a lot of gains had I decided a year ago or back in April or a month ago to just stop investing. Now, to be fair, I'm not like approaching retirement. I'm not in retirement. Obviously that calculation might be slightly different, but yeah, that's my first thought as we stepped into this conversation.
Yeah, so just a little more precision on those numbers, I think is kind of useful. So I think we recorded that episode on November 19th, so that Tuesday before it came out. And the S&P 500 is up 12.9% since then.
Since then, I thought it was since the bottom. Yeah.
Yeah. No, since then. It's up a good bit more than that. Since the bottom, it's up probably 25% since the bottom in early mid-April. The Liberation Day sell-off that we saw following with the tariff announcements and all that kind of stuff. If you annualize that, because it's less than a year, that's about 15% annualized returns. Again, we're going to get into more of kind of the details and that kind of thing, but it's kind of the same trend that we've seen really for the past few years, is that tech companies continue to just power big earnings growth. AI is certainly fueling a lot of speculation about the next big ongoing economic boom, right? We'll talk something else we'll talk more about is basically everybody feels like to some degree there is going to be an AI bubble just because of the history of every big transformative thing ever is a rapid, massive build out and investment in that thing that leads to a bust, right? Because there's too much of whatever it was and there's too much supply, there's too much capacity, whatever. And they don't realize any value in the near term. And it feels like that's probably going to be the case to some degree with AI. Where do we want to start here, though? Do we want to start with the macro stuff or do we want to start with the AI part of it?
I want to start with the AI thing because one of the things I've been wondering lately is it seems like there's two simultaneous things happening, right? There's obviously, call it what you want, a bubble, momentum, excitement, or a legit need for this AI build out, right? Depending on where you fall on the spectrum of how bubbly this is. But simultaneous to that is what I think is a speculative gambling YOLO aspect of the market that I think really hasn't been here since the pandemic and hasn't fully gone away. It's ebbed and flowed. And it's, obviously in 2022, we had crypto winter and there was a little bit less of that because the market had a prolonged downturn. Taking a step back and looking over the 5 years since the pandemic, it does seem like over that amount of time, if I was going to chart it, speculation up and to the right, right? Over that time. And one of the things I'm wondering is if those two things are actually completely unrelated. And what I mean by that is there is a scenario in which the AI thing either isn't a bubble or just goes on a lot longer than people think and pops 7 years from now, or just slowly kind of fizzles out and it becomes like the kind of bubble pop like we saw in the early 2000s. But at the same time, some other thing, and we're going to talk about all the different factors here, whether it's tariffs or whether it's interest rates or whether it's job losses or the economy generally or the government shutdown that's probably going to happen within hours of us taping this. One of those other things could be the reason the market goes down and the reason the speculative stuff slows or maybe goes away, especially if it's a very bad economic downturn. Like if we hit a legit recession, I feel like that could happen. And all of the AI tech companies could continue to spend hundreds of $millions on the AI build out. Like we talk a lot about those things being conflated and together. And I just wonder if if their future could be not necessarily correlated. And the opposite could happen too. A bubble pops in the AI world, but maybe the market itself and the economy is more resilient and therefore it's not as bad of a downturn. I guess the worst case scenario is if both happen, right? There's an economic downturn simultaneous to the AI bubble popping, because the AI bubble has been a large part of what has propped the market up over the past 6 to 8 months as there's been weakness at times. So anyway, that's kind of my big AI thought. Like, I don't know that it's necessarily has to be tied to what the rest of the economy and the stock market does.
Ben Carlson wrote about it, I think maybe sometime in the past week. calling this the weirdest bubble ever, talking about the AI bubble. And he shared a blurb from Michael Cymbalist, who's an analyst at JP Morgan, from a research piece he did. And here's the blurb I'm going to show you again. This is from Ben's Wealth of Common Sense blog, quoting Michael Cymbalist. AI-related stocks have accounted for 75% of S&P 500 returns, 80% of earnings growth, and 90% of capital spending growth since ChatGPT launched in November of 2022. And that kind of gets at the heart of this, right? Again, because the earnings are growing for these companies, largely not because of AI. I think that's the important thing to remember, because we're talking about Microsoft and Amazon here, Alphabet to a certain degree, NVIDIA. Maybe NVIDIA might be the one exception of the S&P.
They're the ones who are actually seeing the economic benefit right now, whereas everyone else is spending for future growth.
Well, and I would wonder, and I'm sure somebody's done the research, how much of the S&P 500's earnings growth is NVIDIA's earnings growth since that fourth calendar quarter of 2022. And my guess is it's probably a meaningful amount, right? Because this was a very good, profitable company that became one of the 5 most profitable companies that's ever existed. And it feels like it was overnight, but it really did happen in a few years.
Yeah. Well, yes, but again, I just feel like we could see a situation where, and it could happen next earnings cycle, right? All of a sudden companies start reporting, and if they're not explicitly tied to the AI boom, maybe they start to see customers pulling back on spending and their margins compress and their revenue growth slow and their earnings per share dip. Like but at the same time, all the Mag 7, all the tech companies, the CRWVs, all those, they could still be crushing it. Like that, it'll be really interesting.
We already are to some degree. Look at Starbucks. Look at most of the fast food restaurant space. Look at the
but I would say
of the Targets of the world. But my point is that there are businesses
maybe it started
that are
already,
selling directly to the consumer that are very reflective of the bifurcated economy, because we've talked a lot about, with the economy, there's a bulk of the consumer spending that's coming from a minority of the population that happens to control most of the disposable income. So I would posit that we're already seeing that to some degree. I think we can go from here and talk about what the Fed did recently, cutting interest rates in an environment where inflation is still far from under control and well above that stated 2% long-term goal. The Fed is more concerned about employment than it is about inflation in this environment, right? So that's another reason to ask the question of how long can the spending for AI continue to prop up stock market returns? Because I think that's a reality.
Yeah. And maybe you're right. Maybe what I'm talking about happening has started, because you're right. A lot of the consumer facing retail restaurants.
Look at Nike's results. They haven't been great in years.
Yeah.
Right.
So it could be. I mean, but I guess what I'm saying is, like, I don't have the data in front of me, but I'm sure if you said, what was the overall earnings per share beat for Q2 across the S&P 500, it's going to be really good, because so much of the S&P 500 is these mega tech companies that are crushing it with AI. But I didn't get the sense, just, the companies I follow for my own portfolio or for work I do around investing in stocks, I didn't get the sense that it was a bad quarter. You know what I mean? It felt like most companies were doing fine, like beating their guidance, meeting their guidance, certainly not a sea change in terms of results. So maybe that happens, or maybe it doesn't, or maybe what we're seeing in the consumer is the canary in the coal mine, right? And it starts to trickle, up or over into other businesses over the next coming quarters. I just, like I said, I'm just interested to see if that actually disassociates from the AI benefiting companies and the results they put up. So let's pivot to interest rates, because you mentioned it there a minute ago.
Before we do, though, because I think there's another important part of this story that's not necessarily directly about AI, but it is a big part of what's happening in the moment and what's different, but maybe less different than it has been in the past. So we look at these past market crashes that we've seen. I'm talking about the big ones. Equity has been washed out because of these big collapses, the ways that equity and debt have been washed out. So you think about the financial crisis, right? All of the defaults that happened, the people that own the debt took a bath, ended up owning houses that nobody wanted to buy, and billions of dollars was lost, and it destabilized the global economy. We go back to the dot-com boom. Investor equity was wiped out. Common equity was wiped out because everybody was chasing the market higher to be a part of the internet, whatever that meant. And nobody's business model, for the most part, really laid out what that meant when they were talking about clicks, right? They were talking about visits to websites. Those were metrics that they were using to pitch their businesses, not actual economic generating metrics, right? And of course, the crash happened, and here we are now making a podcast because of the internet, right? Having met because of social media, because of the internet, 25 years later. You go back to the railroad. This is one that gets brought up a lot. You can look at a lot of things that happened at the kind of the birth of the Industrial Revolution, where there was massive build out in hard assets, that there was way more capacity that was built than there was demand for the products that could be made or used on that infrastructure, and lots of debt and equity losses were resulted. One of the things that a lot of people talk about with this one to say that it's different is, well, Microsoft's got all this cash they're using to pay for it. Meta's a cash cow. They're using that to pay for it. Amazon, et cetera, et cetera, et cetera. And I want to poke a couple of holes in that a little bit, Jeff, because yes, to a large degree, companies are using their cash flows to pay for this, probably more for any major transformational technology in history. I think that's clearly the case.
Right. There are real metrics here, not
right
clicks to websites.
Right. But it's not completely right, because Meta had a pretty big net cash position. We went back a couple of years ago. Meta, by the end of this year, is probably going to have $30 or $40 billion more debt than it does in cash, as it has taken on debt and depleted its cash to pay for its infrastructure. We're seeing a lot of companies that are starting to take on debt to pay for these initiatives. I bring that up for two reasons. Number one, the narrative isn't exactly true. The other part of it, and our good friend Tyler Crow, who owes me an appointment to make another episode of Misfit Monthly for our listeners. Yes, Tyler. Yes, that's directed at you passive aggressively through our podcast. Tyler has pointed out that a lot of these businesses built businesses that were very capital and asset light, very high margin, very cash flowing businesses that are now moving into building out and owning and operating like real infrastructure that has operating costs and has an upgrade cycle for a large portion of that capital investment they make, that they're going to have to refresh, every few years as the obsolescence of tech hardware proves to be the reality. And his question is, how much of these business models are going to be affected, and the margins that we've come to expect from these companies are going to be eroded as price warfare. We always see it for software, and AI is software. It gets cheaper. It gets constantly cheaper. And the value is created because, the massive growth in the utility of it as the cost comes down. Is the math just going to change for these companies, and the profitability that we're expecting is not going to look like the profitability that we get?
I think that's a fair point. I mean, these companies are stepping into this CapEx spend cycle better positioned than I think any previous bubble burst.
Yeah, well, like Ben Carlson put it, though, he said, they're spending like drunken sailors that can afford to keep buying the booze.
Right. So if you ask me to predict where we're standing 30 years from now, I would say all of these huge companies are going to be just fine, if not slightly less profitable, and they'll recover if they do hit a crash and be fine in the long run. The question is, what damage does that do to the overall market and economy in the meantime, if there is like a big crash?
Well, investors that have to invest through it.
Yeah. But I've been saying for a long time, like I truly believe, much like with these previous bubbles that eventually turned into things like the internet, the big winners, the ones that are going to be the next generation Mag 7 haven't been
We may not know
invented
who
yet.
they are.
They're not even founded. You know what I mean? Look at when the internet started and when that bust happened, and then look when Facebook started, like 2004, right? So it was, a good 5 to 7 years after that crash. So, and then, that's just one example. You could, Alphabet.
Netflix is another good example.
Right.
Yeah.
All right, folks, if you're a regular listener to Investing Unscripted, then you know that we use Fiscal.ai, formerly known as FinChat, daily. Fiscal.ai is our complete stock research terminal. It's where we have our investment dashboards. It's where we create financial charts. It's where we read all the transcripts for the conference calls, sell-side events, shareholder meetings, and it has Morningstar's high-quality research reports on more than 1,700 companies. It really is the complete research platform for stock-focused investors. If you use our link, fiscal.ai/unscripted, you will get an automatic 2 weeks of Fiscal Pro for free. And if you find that it's worth upgrading, you will get 15% off any paid plan with that link. Again, that's fiscal.ai/unscripted. The link will be in the show notes.
Hey listeners, my name is Brett Schaefer, one of the hosts of the Chit Chat Stocks podcast. On our show, we do comprehensive stock research reports, interview analysts, and learn from great investors. And we have coverage on stocks like Airbnb, Nubank, Mercado Libre, and many others. Plus, we cover all the hot financial news on our weekly investing power hours. We have episodes for all types of investors, and think if you listen to this podcast, you will enjoy ours as well. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
So, I think that's how this shakes out. But all right, so that's all fair. I think that what we're kind of dancing around with this whole first part of the show is to what degree the AI spend and the companies doing the spending will or won't impact the overall market. Like, will that be what prevents or causes a crash whenever we do get one? I think that's the unanswered question, but it's interesting to think through all the different ways it could go. So let's, like I was going to say before we went on that last little bit, let's change topics to interest rates, because I think second to AI, that's been the most prominent recent development in terms of the last couple months. I feel like the tariff talk has chilled a little as we wait for the Supreme Court to either declare the tariffs legal or illegal. But, we had the Fed rate cut 2 weeks ago at this point. There's plenty of predictions and pricing in to the market that there will be more rate cuts to come, but we'll see, because as some of the data would indicate further rate cuts, some of the other data would indicate a reason not to. So it will be interesting to see what the data says and how things change between now and the next Fed meeting, and then the ones after that. The other thing that'll be interesting is if there is a government shutdown, which by the time you're listening to this seems pretty likely there will be. Do we still get those numbers on time, or do they conveniently become the kind of thing that there's no money for during a shutdown? So that'll be an interesting political thing to watch as time goes on. But what are you thinking right now in terms of interest rates? Do you continue to think like the market does, we're going to get more this year? Do you think it's up in the air still? How are you looking at that?
Yeah, I think it's probably a foregone conclusion that rates are going to get cut one or two more times, despite what the Fed chair said in his prepared remarks and Q&A after the meeting where they did cut. I think there's definitely more concern about jobs right now than there is about inflation, because if that weren't the case, again, inflation's been, in the mid to high twos, and that's 30 or 40% above the 2%, which is that's where they're we haven't seen 2% inflation in 6 years. So to be lowering rates right now, obviously the mandate and the focus is on making sure employment is propped up and freeing up capital resources for businesses, so they're not cutting from this point. So there's just more stability. I think that's a likely reality. And here's the thing, dude, it's young workers that are increasingly struggling to find work. And it does look like if there are threads to connect this to AI, entry-level jobs in technology and in a lot of the businesses that are starting to use LLMs and agents more for things, it's the entry-level jobs that are being replaced by the robots at this point. You are muted as hell.
I think this will be a major driver, but another kind of wrinkle in this whole unemployment picture is, again, if we do have a government shutdown and the Trump administration does what it's threatening to do, which is just fire a whole bunch of people during the shutdown, that, and I don't know how many that could be or would be, but let's just say it's enough that it has an impact on the job numbers, right? That's just another, tick on the side of the scorecard for more interest rate cuts, especially if inflation doesn't go back up, just kind of stays where it is, even though it is still above the 2% target. So yeah, it does seem like the Fed is viewing the job market as the more dire half of the dual mandate than the other part of it at this point. So we've talked about inflation as it relates to interest rates, but that's another thing that is still something we have to keep an eye on, right? Where does it go? Where is it? I think what's interesting about inflation to me is it has been sticky, right? Let's just say that, because it hasn't gotten back down to where they want it to be, that 2% target. But this is another thing I've been wrong on, and I feel like a lot of people have been wrong on this, is, we had the Liberation Day tariff announcement April 2nd. And of course, the thing everyone says when it comes to tariffs is it's inflationary, right? It drives prices up, it's inflationary. And then a month went by, and 3 months went by, and 6 months went by, and we haven't seen that much tariff-related inflation increase, right? We've seen some, but not a lot. But I keep saying, but what about, back in June, I was like, well, maybe we see it by September, and now we're at the end of September, and I'm wondering, maybe we see it in October or November or December. Maybe it's Christmas season when there's less stuff on the shelves. I don't know, but I'm not an economist, but it does seem like the economy has handled the tariffs better than a lot of people, including myself, anticipated, at least in April. So, but that is still a shoe that could drop. There is still a scenario where this is just a really delayed thing because the supply chain just is long in terms of time, right? It takes 6, 8, 9 months for things to go from we should have this on the shelves to it's on the shelves. And the other part of it is the thing that every company did immediately when this was announced was they front loaded as much as they could. They increased their inventories, they rushed stuff through. So there's also a scenario that what would have taken 6 months for us to see the impact is going to take 9 or 12 because the companies did such a good job of getting the stuff here ahead of time. And now they're just burning through that pre-planned inventory. So I kind of want to stop predicting where this is going to go because I'm always wrong. But it is something I think is still a factor that could contribute to a crash if we have one this coming year.
Yeah, I think that's probably part of it. Because certainly this was actually part of the Fed chair comments after their most recent meeting was that the impact of tariffs was certainly lighter than what the economic data reflects. It was certainly a lot less bad than anticipated. And the combination of two things happened. Companies, like you said, front loading stuff, but also businesses apparently deciding to soak up more of the costs than anticipated.
Which can't last forever.
No, right. It can't last forever. But also I think it's just a reminder that with some industries, because we're basically 5 months post the rollout of these tariffs, and a lot of industries, I mean, it takes months for things to work through the supply chain, like the auto industry, for example, building materials. It takes a while for those things to work through the different distribution points before they end up in the end market. And at some point, it's, those things are going to start showing up more directly because not only is it going to be harder for companies to soak it up, industries that so far really haven't had to completely deal with it are going to start having to, right? Because these things are starting to move through their inventories and they're having to account for it when they're selling a product as a cost of goods sold, right? So that's a reality that's going to start playing out to some degree. I don't know how much it's going to affect things at this point. The bigger question that I continue to have though, is the companies that have been successful are the ones that are selling to people with money. That percentage of the population that controls most of the disposable income and the spending have continued to spend through this. And we've yet to see any significant signs of fatigue from those spenders. And will that change? I think that's an important thing that we have to acknowledge.
Yeah, and I think that will largely depend on when the next market crash or economic downturn comes, because it's a when, not an if. It probably depends on how long and bad it is. Like 2022 felt bad to be in the middle of, but in the scheme of things, it wasn't that long. Right? Sometimes these things can take years to get back to all-time highs, and that was 18 months or something like that. So, that I think is an important thing. All right, let's pause here, because we've talked about a few things, right? We've talked about AI bubble, we've talked about inflation, we've talked about interest rates, we've talked a little bit about the government shutdown. What do you think investors who are listening to this should and should not be taking into consideration when making decisions about all aspects of their investing life? So whether it's buying stocks, or whether it's changing where they're allocated, or whether it's thinking differently about cash or how to hold cash. I have an answer, but I want to know how you've thought about it and how you think it makes the most sense for others to think about it.
I think the first thing that people should do is go to savvytrader.com and subscribe to the Savvy Trader Investing Unscripted Portfolio.
Smart.
That's smooth, right? That was really smooth.
Yeah, really well done.
But no, seriously, let me just take a second and do the pitch here. We talked about it before. We're running a 25% off sale this through October 25th. The code is Unscripted Autumn. So people that have been interested in joining, now's a good time, because we're actually starting, I think, to maybe do a few things that are reflective of our concerns about the market in the near term, and think about how we manage our own portfolios in the real world with those actions, and maybe offer some interesting ways for other people to think about what they might want to do. So for example, in September, our biggest winner so far, we're actually trimming that position just a little bit. I think it's gotten way ahead of itself. So we're trimming that one, and we're splitting the proceeds of that trim and adding to two other existing positions. One that's done well, but we still think is pretty beaten down, and another one that's very beaten down. We like the industry that they're in over the long term. So that's kind of the bigger focus, is the long term. And we're opening a starter position and a third stock. I guess technically it'd be a fourth stock, because we have three others that we're involved in that we really like what they're doing, and we like the prospects. Of course, I was being tongue in cheek when I said I think that's the first thing people should do, is subscribe to that. But I do think the first thing that people should do, and this is certainly something that I've lived when it comes to my portfolio, is remember what I'm trying to do and when I'm trying to do it, right? Because perfect example is, last year when we did that show, we were right in the short term. We were lucky, but we were right, because the market peaked a couple weeks after we recorded that, because it went on that runner after President Trump was elected. And then it just started to kind of peter out. And then all of the tariff stuff just really rattled the market, and it was down 15, 16, 18% from the peak. So we were right by being lucky, not because we had any special insight, but the markets continued to run. And anybody that went to cash when we said, hey, the crash is coming, or here's our fears, even though we were being completely tongue in cheek with it, they would have felt really smart for a while. And this is the thing, I guarantee you, when the market hit bottom and then started to go back up, they would have done what humans do. And that's continued to sit on their hands, waiting for the next leg down.
Right.
And be sitting here, 15% poorer as a result of that, right? Because we don't know what's going to happen in the short term, but we do know in the long term, the market's been the biggest wealth creating machine in the history of mankind that's accessible to regular people. Because over the long time, companies grow their profits and become more profitable per share. The economy gets bigger. More people enter the middle class and have disposable income. Businesses become more efficient and they generate more profits, right? As they become more profitable, and it compounds, right? It compounds and compounds. So what are you trying to do? And for me, it's remembering that long term, but then at the same time, all goals aren't long term. And be mindful about short-term goals too, and make sure, if you were somebody that was going to retire last April, and after President Trump was elected, the market kept going up, and you're like, yeah, you know what? I'm not going to go ahead and sell that 5% of my portfolio to free up cash for the next couple of years. What would happen at the bottom? You probably would have sold everything and you'd be sitting on a bunch of cash. And here you are again, you'd be poor. So just basic, blocking and tackling of investing and thinking about position sizing, thinking about asset allocation, just all of those basic things that we can do that prevent us from whatever our worst tendencies are that destroy wealth, prevent us from acting on those things.
Yeah. The closer I get to retirement, which is still very far off, but obviously I'm closer now than I was 5 years ago. I think to myself, when I'm close enough that when I have feelings about the market like I do right now, transmit how I'm feeling now to when I'm 60. I think at that point, I'm paying a professional to bounce ideas off of and to look at my overall picture and to tell me, now might be a good time, take a little off the table, whatever, do this, do that. So I'm not, that's all I'm going to say about that. And I know we have some listeners that are, near retirement, in retirement, they might hear what we're saying and think differently. To me, the answer to what to do in a time like this, when you're feeling this way or you're hearing the news, really depends on the type of investor you are.
Yeah.
So if you are a index fund, mutual fund, every 2 weeks comes out of my paycheck, goes right into my retirement account, I set and forget it, I don't think you do a damn thing, to be honest with you. I think you just go, especially if you have 10, 15, 20 years before you need that money.
That's the key, that last part, assuming that your asset allocation makes sense based on when your financial goals are.
Correct. If you're a stock picker, either entirely like you are or partially like me, I think that also is a depends answer too, because it depends on how much of your portfolio is in stocks. So I think about whether I want to change how I invest, not if I invest, but how I invest, probably more than I even need to because of how small that part of my overall invested money is. If you're someone like you, Jason, who's 100% or almost 100% in individual stocks with bonds on the side and things like that, maybe you do need to be a little bit more careful where you allocate new money. But to me, if you're going to be on that level of like this stock versus that stock, it has to be based on an understanding of the business and not just, I saw a CNBC hit and they said this is going to go down or that's going to go up. And I think that's like just people in my life, like normies in my life that don't care or do what we do, but just have some stocks. I hear them say things when, because they hear the news, they read articles and they'll say things like, oh, I gotta sell some stocks where there's going to be a market crash, but they're just doing that off of vibes. Like, I think
they state these prognostications as if they're absolute facts based on something they heard with absolutely no context and on some financial media source.
And honestly, just to kind of pull this back to like practical uses for AI, like in today's world with ChatGPT or Gemini or Claude or whatever you like to use, all it really takes is asking one of those large language models, hey, what did NVDA say on their conference call about tariffs or about inflation or about, if you're wondering like how the tariff is going to impact them, and you can get a pretty quick answer that's probably accurate, or at least you can check it, go back and double check to at least understand like how these things you're worried about actually impact the businesses you're invested in.
Yeah.
At least that's what I've tried to do. Like when the tariffs were like new and the big thing back in the spring, I was thinking to myself like, okay, what in my portfolio could get whacked if in the short term, not long term, if there's tariffs, and do I want to put my money somewhere else? Or do I want to wait for one of those things to happen and put my money there because I think it'll recover? Like a good example for my portfolio, because it's a stock I've talked a lot about recently and I have a high conviction in, is Warby Parker. There was a day, I don't remember if it was Liberation Day, but right around there where their stock dropped like 17% in a day because they source a lot of their materials from China, right? Like they make $95 glasses with the lenses. So they're buying the materials from China. And then when, I think it was Liberation Day, they got whacked. And then 5 days later, when the tariffs got rolled back, their stock went back up 17%. So not back to zero, but they got a lot of it back. And they've been up since then and they're fine now. But I remember thinking in that moment, this actually really could impact this business particularly, because if they can no longer be the low cost glasses start at $95, that's their whole thing.
Their business model. Yeah.
Right. So that's an important impact versus like another company that might feel the impact of tariffs, but they have some wiggle room on pricing, or they can eat the costs, or they have the margin room to not pass it along immediately. So that's what I mean. Like you don't have to be a, professional analyst with a CFA to at least just think through like, okay, the tariff was this on this country. Does that impact my investment? I think that's how I think about it. Like, you can't completely ignore it if you're picking stocks, but you also can't react just to the news. You got to take like a one step further and dig a little deeper to get a sense of what you own and how it's impacted by whatever the thing is: AI, tariffs, inflation, interest rates, all that.
The old saying, risking what you can't afford to lose to try to earn what you really don't need, always kind of stands out to me. And in our Discord that the $5 a month subscribers get access to, Vinny shared a really interesting anecdote about his personal experience of basically having to get rich twice. Over 60, portfolio hit an all-time high in 2021, right? During that run up. And Vinny stayed 100% stocks. And less than a year later, had lost 40% of his wealth. The secure retirement became far less secure at that point. Fortunately, Vinny's been able to enjoy the market's recovery and learned a lesson and has started practicing some asset allocation. So I think that's the thing that just stands out. If I were just to kind of sum it all up in one word, is as much as AI has so much potential and we've all profited from this incredible market run, once you get to a point where your financial goals are pretty well locked in, you have this wonderful, wonderful opportunity to take some risk off the table, right? And I think it's an important thing for people to remember. You're so fucking good at muting today.
Yeah. I paid a financial advisor just an hourly rate to look over my investments about a year ago. Even though at age 45, I'm 20 years away from retiring, or at least from stopping working. I might change careers at 55. And even at that point, the recommendation was to have a little bit more bond exposure. Yeah. Now, I ignore that because I don't think I need that a little more right now. I think I have enough for where I am. But again, everyone's comfort level with that aspect of risk is different. But that's why I'm a big fan of, as I get closer, I think every 5 years or so, I want to just have another look over, because I might feel differently about when I want to retire 5 years from now. Who knows? I might be like, maybe 60 instead of 65, or maybe 70 instead of 65. So I think just having, it's good to talk about it. It's good, obviously, to subscribe to this podcast and listen to us and send it to your friends and give us ratings and reviews and subscribe to the Savvy Trader. But it's also good to get someone who's completely disconnected from all that to just look at the hard data and be like, here's what I think you should do because you want to retire in 5 years or whatever the scenario is.
Right. Particularly when their incentives are to generate an analysis and feedback, and not just to capture your money as assets under management as perpetually long as possible. So I think that's smart. And I know it was useful for you. I learned a lot from what you paid somebody else to do. So thank you for doing that.
That's fine. I've been skimming off the top of the podcast revenue for the past couple of years. So you paid me back.
Ladies and gentlemen, Jeff Sansoro, Unscripted Media Global's CFO.
That's right.
Yeah.
Who's so good at the stealing that he admits it on a podcast. All right. So we're wrapping up here. We're getting near the end. Of all the things we've talked about, what haven't we hit on yet that you think is something that, if we do get some sort of crash in 2026, you think could have been a contributor to it? What haven't we hit yet?
My guess is that we haven't hit on whatever causes the crash.
That's right. It'll be something that no one can think of right now.
Yeah, no, because there's like $7 trillion in money market accounts, massive dry powder. Gold is at all-time highs. So there's a tremendous amount of money invested in gold right now. So, I mean, there's all of like the uncorrelated safe assets are worth a lot of money. And while the stock market's at all-time highs. So there's almost certainly going to be something. We just don't know what it is, and we don't know when it is. I am going to predict that it comes late next year, though.
So I actually wanted to wrap up with that question. We tongue-in-cheek named the episode Market Crash 2026 because honestly, that'll get people to click on it. But I don't know where I fall on this. I've been saying since April, and honestly, it was even before the tariffs. I was saying really since January, like, the chaos itself, the unpredictability of the world we live in right now, and you can take that in any direction you want, whether you're a fan or not a fan of the current administration. I think it's fair to say it's been unpredictable and chaotic, and news comes at you fast, right? Typically, the market doesn't like that. So my rolling theory since January has been, all of this uncertainty has to shake the market. We're going to have to see, if not a crash, at least some sort of downturn. I think my prediction might have been that we just see like a up 1% kind of a year where it just sort of middles around the whole year. And I've been very wrong. And then after Liberation Day, I was like, this has to happen. The tariffs will catch up with us. Inflation's still high. They haven't cut interest rates yet. And here we are heading into October. Everything's fine. Oh, like my brain still tells me, yes, at some point this has to catch up and this will happen. And obviously over a long enough horizon, it will. But would I be surprised if we do this episode next year in October or November and we still haven't seen a crash? No, I don't think I'd be entirely surprised because I've just been wrong for the past 2 years.
So yeah, I'm going to say we see a 12% sell-off at some point next fall. And then in November of next year, we will be recording Bull Market 2027.
Yeah, that there will be a year when we're so tired of the downturn, we'll start to do episodes about when it'll turn around.
There you go. All right, Jeff, I think we've said enough words about things for today. What do you say?
I say you wrap it up.
Okay. All right, everybody. As always, we love to give our thoughts and share our answers for these hard questions about investing. And maybe more importantly than our answers, talk about our processes and how we're thinking about our financial goals. And it is always up to you to do the same thing. Our answers are awesome. Your answers matter more for you creating the wealth and protecting that wealth for you and your family. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.